as well as other partners, and I'll talk a little bit about that as well, uh, to to support and provide resources so that families and individuals have access to programs that can assist them to purchase a home. So although you see a little bit of the logo of my of my bank, but know that this information is really educational. You have Juanita and all the wonderful people at the Achievement Academy that can assist you along the way. So know that you will always have access to resources. If home buying is a goal, know that the San Diego Housing Commission definitely is an organization that can help you achieve the goal. So with that, I'll jump right ahead and just once again thank the Achievement Academy for having me here. I will. I'm not going to go through every single slide. I will make sure to allow time so that we can answer questions. And I know Juanita will be monitoring the chat. So feel free to, if during one of the topics, if you have a question, write it in the chat. I may answer the question as I progress, but know that all your questions will definitely be answered today. So, just a few objectives, right, of what we want to accomplish today is to provide you an overview and understanding of the home buying process, determine how much you can afford. That's always very important. Affordability. And before we got started today, we talked a little bit about affordability. So I will dive in deeper as to why that is so important. I always relate home buying to as if you're running a marathon, right? You just can't wake up one day and start running the 26.2 miles, right? You have to progress, and home buying is no different. So you have to take steps to prepare yourself for this process. So affordability is very, very key and important in this process. We'll talk a little bit about some of the mortgage basics. We'll talk about some of the options that are available and any special programs that are out there. So, in general, when we say this, there's really not an exact blueprint to purchase a home. Everyone may start the process slightly different, but a very common denominator is to research and educate yourself on the process. A workshop like today, for instance, for many of you could be your first step. So researching the local housing market, nowadays there's a lot of free information through platforms, online platforms that are out there. Zillow, Redfin, just to name a few. Where if you were to even Google, right? If you were to just Google home prices, you will get instant information, right? So definitely use those resources as leverage. But once you have an overview, right, of where to begin, typically you would speak to either a loan professional, such as a loan officer, or a mortgage broker that has access to mortgage programs, or a housing counselor. So there are great nonprofit organizations that can assist you as well to determine whether or not you're mortgage ready. Housing counseling is perhaps one of the best kept secrets in home buying because a HUD approved organization, uh, as a housing counselor, they can assist you to create an action plan. So let's just say that you're not quite ready here. We're not quite mortgage ready, but with an action plan, we can begin once again to work on the things that will allow us to be mortgage ready in the future. So once again, kind of like running a marathon, right? Whether it's a long-term plan or a short-term plan, working with a housing counselor can assist you as well. Um, and once that pre-approval, what that means really is that once you speak to a loan officer, the loan officer will verify three components of a mortgage loan application. They'll run your credit, they'll verify your income, and verify your assets. With those three things, you can get a what's called a pre-approval So you know what your purchasing price is, you know what your purchasing muscle is, as well as how much can you pay every month. Affordability, once again, very important. Um, Once you start working with a real estate agent, you will look for a home. You would submit an offer. Now, I'm going through this pretty fast, but know that we can actually just spend hours on just the submitting an offer piece. But um, just when you submit an offer, it's your intent to purchase a home. You can negotiate to an extent the purchase price. Uh, Once your offer is accepted, that's truly when your complete mortgage application process begins. Um, there's home inspections that need to be done. Depending on the types of programs, there may be required additional home inspections as well. Any type of repairs, you can negotiate that with the seller. You have a what's called a final walkthrough. So even right before things are going to reach the finish line, you actually have a walkthrough on for that property just to make sure things are how they were when you started the process. And of course, you would close on the mortgage and move into your home. So obviously, I explained that rather quickly, rather fast. During this process, you potentially will encounter many different twists and turns, which is normal, normal, which is the normal process when buying a home. So I know I said pre-approval, right? So the difference between a pre-approval and a pre-qualification is really the verifications that are done on a pre-approval. So once again, a pre-approval is when your credit is actually ran, your income is verified, and your assets are verified by that loan officer or mortgage broker. A pre-qualification is more of an estimate. So this is where on a pre-qualification is more geared towards either a housing counseling, um, but more importantly is when there's no verification. So your credit's not ran. You can talk about your income, but your income may not be necessarily verified or your assets, right? So a pre-qualification is kind of like, a good rule of thumb, right? You're guesstimating, to say, for lack of better words, but a pre-approval is actually more precise. Um, and oftentimes, a pre-approval does have a commitment, a written commitment from a specific lender, which has a time bound. As you can see there with Citi, when we issue a pre-approval letter, it's good for 120 days. So within those 120 days, you would have done what we talked about previously, right? Going through that process of buying a home. And if you're still not, or you still haven't found a house yet, typically that 120 days can be extended for an additional period of time. Um, so know what you can buy, right? So affordability, very important, very important. Oftentimes within the housing counseling field of providing someone guidance, they would recommend an activity um, where if you're currently renting right now, pretend you have a mortgage payment. How does that work? Well, if your rent right now is, let's just say, $1,500 a month, and let's just say that you were paying a mortgage of $1,800 a month, right? So essentially, you're pretending that you have a mortgage payment. Instead of paying your landlord that extra additional $300, pay yourself that extra additional $300, right? So at the first of every month, in your mind, you have a mortgage payment of $1,800. Um, and if you find yourself that you're consistently able to keep those $300 in your savings, then you're going in the right direction. However, if you find yourself having to transfer that money back into your checking because you need that amount, right? Then that's where we can kind of go back and make sure that we determine how much we can afford and make sure that we tighten up on our monthly household budget. Determine how much cash you have for down payment. So very important because although there are great programs that exist for first-time homebuyers, San Diego Housing Commission has one of the best programs for down payment assistance. It does require you to have skin in the game. What that means is you will require to put money out of your pocket. Oftentimes, um, you know, people may have the notion that because they qualify or eligible for certain programs, which is great, that they're not going to require any savings from their end. Um, and that's not always true, because you need to have, once again, skin in the game. How much will depend on each individual and each transaction, but know that you have to be prepared. Once again, we're running a marathon. You have to be prepared with some savings. Calculate your monthly income and expenses. That's something we all should be doing now, right? We all should be following a household budget, a household savings and spending plan. Why that is so important is because if we don't have that savings, we have to look into our resources of our budget. We have to identify where we have potential spending leaks. Um, Referencing housing counseling again, they often refer to a thing called the latte factor. If you were to go to Starbucks Monday through Friday and spend $5 each day on coffee, at the end of the year, you would have spent $1,300. That's the latte factor if that was something that you chose to do. Um, I'm sure we kind of go around the virtual room. We all have our latte factors, right? Whether it's coffee or whether it's cable TV, perhaps additional services that we subscribe, whatever that whatever that may be. Understanding priorities could essentially help you tighten up your budget, of course, and find spending leaks so you can maximize your savings. So once again, um, things that you may already be doing or you can start to do even before we begin the home buying process, right? Once again, prepare financially fitness, right? For home buying. And of course, determine the type of property you may be interested. This could uh, be different from different individuals, different families, right? Also, what's real important here is communities as well, right? So let's just say that you're okay to commute a little further, because it's going to allow you to potentially uh, be more in line with the type of property that you are looking for, depending on your household size, depending on your needs, right? Oftentimes we need a one-story home because we have family members that may not be able to walk upstairs, right? All those little things are taken into account to determine the type of property that you would want to consider. So closing costs, just to give you a real brief overview. When you buy a home, there are fees associated that are not necessarily related to the lender. Some fees are what's called third-party fees, and just know that it's tied into what we call closing costs. So very similar to when you purchase a car, you have DMV registrations, transfer fees, well, smog fees, right? When you buy a home, as you can see, there's just quite a bit of different types of fees. Just to give you just a real quick overview, like an appraisal, right? You see an appraisal fee. Well, an appraisal is required because what you are buying, the lender will need to confirm that the value matches what you're trying to borrow. So that's very important. And although the lender requires that appraisal, you as a borrower are actually paying the appraiser directly. So, but it's part of your closing costs. So once again, an appraisal can run anywhere from $450 to $600. That's money out of your pocket, right? So just know that you have to have, the resources, the savings when you start the home buying process. Um, I mentioned some other fees, right? Legal fees, that's on a case by case basis. Here in California, we are a deed of trust state, so technically we don't need an attorney for the process. However, depending on the situation, it could be necessary. But just a quick overview on closing costs. So this screen here helps you identify the pillars to obtain a mortgage. So what do I mean by that, right? So um, a lender, a bank, a mortgage company um, essentially looks at the ability of the borrower to repay back the debt. And that ability is what you see in front of you, those pillars. So for instance, assets, right? Um, Once again, it's not a deal breaker if you don't have, say, a great deal of money saved, but know that is necessary. It's necessary to have a cushion, right? Um, Even if you're only paying for your moving expenses, that's an expense that's coming out of your pocket, right? So know that assets is very important. Um, Property appraisal, I mentioned a little bit about the appraisal. The appraisal is something that you don't necessarily control directly, right? Because you don't decide what the value is in the property, but know that it's an important piece of the puzzle for the lender to consider lending to the borrower based on the appraised value. Credit history, I'm going to touch on credit next, but know that there's two things that a lender looks at in a credit report. That is the score and the content, the score and the content. And every program has minimum thresholds as to where the score and the content need to fall. So I'll come back to credit in a second. Employment and income history, very important because every every program, there's what's called debt to income ratios, which the lender needs to verify that there's sufficient amount of income to satisfy the housing payment and your current ongoing obligations. A few years ago, back in early 2000s, there were programs that did not verify income, believe it or not. Those programs were called stated income mortgage programs, where the loan officer technically stated your income, right? The income wasn't verified. Fast forward to today, income has to be verified because you qualified mortgage procedures need to verify that, hey, the borrower has the capacity to pay back the debt, right? So know that employment and income is very important. And of course, your debts. Your debts are your current obligations. This kind of ties into your credit report, right? So um, your score is looked at, and the content is the actual debts that you have. Um, so I'll dive a little deeper here. So why your credit is so important is because it's perhaps the most significant influencer to determine risk for the lender. How has this person performed with previous financial obligations? They look at your credit, right? Not to say that if we've had issues in the past, we're not going to be able to obtain a mortgage. But if we've had issues in the past, what a lender would want to know is, well, how did this person move forward, right? So that's part of the history of your credit report. But know that your score, your timeliness of payments have the most significant impact on that score, specifically the last 24 months. So let me give you just a quick example. If Juanita has a car payment, I'm picking on you, Juanita, and let's just say that Juanita
That's okay.
made her car payment late on October 2020. Ouch, that late payment last month is going to affect Juanita more than Juanita making a late auto payment from 2017. Does that kind of make sense, right? So anything that we've had in the past 24 months is very significant. Anything after 24 months is not as significant. So technically, that late payment Juanita made in 2017, it's probably not even going to affect her score. But anything within the past 24 months is. So timeliness of payments is very important. New inquiries, if you're going through the mortgage process of obtaining a pre-approval, you definitely want to limit as many inquiries as possible. What I mean by that is you don't want to be shopping for a TV or a car loan if your goal is to purchase a house. Um, so I also always tie into this co-signing. So if you're co-signing for a sister, aunt, brother, friend, and you hear the words, it's not going to affect you, it does. It does affect you. and know that it could potentially hinder you. So even co-signing, the rule of thumb is you don't if you're once again, we're running a marathon. If you're buying a house, and that's our end goal, we don't want to necessarily be co-signing for other people. Past credit problems, like I mentioned, the bank will or the lender would want to know how this person moved forward. Sometimes housing counseling can assist with past credit problems. There may be situations where um, if things are past the statute of limitations for certain debts, you may be provided guidance on whether or not you should really repay that debt or not. So that's part of housing counseling. That's part of credit counseling. Of course, Juanita and the great team of the Achievement Academy can provide more direction on credit counseling as well. But it's important to know what type of past credit problems we have, because there are certain things that can really hinder the process, such as back taxes. Taxes don't go away, unfortunately. So if we have back taxes that we still owe the IRS or the California State Franchise Department, um, that's something we have to address, right? Another thing is potential like child support. Child support doesn't go away. So if that's not under control, we need to have control over that. What student loans, that's another debt that doesn't go away. So if we're not in a repayment status, or we're not current, that's a big red flag. I'll talk about utilization of credit. Typically, like the revolving trade lines, like your credit cards, right? um, the rule of thumb there is not to exceed the limit on your credit cards. In fact, the rule of thumb is use at or below 30% of the available limit. So if your limit on a credit card is $1,000, the rule of thumb really is to keep that balance at or below 30%. It's like almost like playing a game, almost, right? And you got to find a way to navigate through all these hoops that you know the credit score calculations has. But utilization of credit, right? The more you're using in your available credit line, you're looked at with the higher risk versus using less available credit of your trade line, that's looked at with lesser risk. So just a quick overview on credit. Why the content is so important is because your current obligations need to be considered, because once you purchase a home, you still have those current obligations. So if you have a car payment, if you have credit card payments, you're still going to carry those obligations into the home buying process. So that's why it's really important that when we're going through the home buying process, that we try to really limit the amount of outstanding debt that we have, because that essentially can limit how much purchasing power we're going to have. The lender has to, once again, know that whatever obligations you have, they have to fit into that total complete debt to income mortgage payment. Um, and if we have a lot of obligations, that's going to affect our ability to purchase a home. Application checklist. I think I can just skim over this. When you apply for a mortgage, as you can imagine, there's a lot of documentation that needs to be provided. So know that it is a lengthy process. Be patient with whoever is helping you, because they're going to ask for certain items, perhaps more than once. There's a lot of verifications in the back end that are done, such as employment verification, asset verification, rent verifications. So just kind of prepare yourself that you're going to provide lots of documentation. Nowadays, most banks and lending companies do a lot of things virtual, so that's going to help quite a bit. But know that this process is lengthy, and if you're organized with your financial documentation, it makes things a lot easier. So what do I mean by organized? You have like your last 2 to 3 years income tax returns filed and ready. You have your bank documentation ready, your employment documentation ready. All that helps the process out. So your monthly payment, why this is so important is because um, when you are renting, you have one housing payment, which is your rent, which covers your stay, right? To your or your right to use that dwelling as your home. When you have a mortgage, your housing payment is actually comprised of several different layers. So, for instance, principal and interest, that's really your mortgage payment. Um, so that's really the amount that goes to the bank or to the lender, right? So if you have a mortgage, and I'm going to throw out fictitious numbers. If you have a mortgage of $350,000 at say 3.5%, your mortgage payment is $1,300. Once again, fictitious numbers. Then you have your property taxes. Why do you have to pay property taxes? Well, you have the right to own a home now, right? So the dirt, right? The dirt where the home is, that's value. That's the property value, and you have to pay certain taxes. Your property is assessed from the first year of purchase. Every community has a slightly different assessment. So whatever that assessment is, you will be making your tax payment twice a year. However, the bank will want to manage this for you if you're not putting down 20%. If you put down 20% of your down payment, you can manage your property taxes yourself. If you don't put 20% down, then the bank or the lender will want to manage this for you. And what they'll do is they simply take your property tax amount that you would have paid throughout 12 months and divide it by a monthly payment, and that portion would be included in your housing payment. So you have your mortgage and your property taxes. If you're buying a single family residence, you're going to be required to have homeowners hazard insurance. That's an extra payment that you will have as part of your mortgage payment. Um, if it's a condominium or a townhome, you will have what's called homeowners association dues. Although the homeowners association dues, you pay that directly to the association, it's still considered as part of your complete housing payment. So just to compare apples and oranges, right? If you're renting now, you have one housing payment, right? If you're a homeowner, you're going to have a housing payment with different layers, right? Principal and interest is the mortgage. The property taxes goes to the city or the county. The insurance, right, goes to the insurance company. And potentially you may have homeowners association, HOA dues, if it's a townhome or a condominium. If the type of mortgage that you obtain has private mortgage insurance is not an insurance that protects the property. Private mortgage insurance, it's an insurance that protects the investor. Whoever that whoever the lender is, for a little simplicity, you have this extra layer of payment if the mortgage program requires the private mortgage insurance. FHA, which is a great program, has private mortgage insurance and typically is added as an extra layer of payment if the borrower is not putting down more than 20%. So depending on the type of financing, you may have private mortgage insurance. Now, there's a lot of other programs out there that do not have private mortgage insurance, FYI, but if you do have PMI, private mortgage insurance, then once again, your housing payment will include your principal interest, which is the mortgage, your property taxes, your homeowner's insurance, potentially your HOA dues if it's a townhome or a condominium, and PMI, private mortgage insurance. So just know that all that comprises your housing payment, and not to scare you, but to inform you, right? Know that you definitely there's great benefit of owning a home, right? The buildup of equity, but know that there's a couple of things that are comprised that add up to your housing payment. So I think I've covered that pretty thoroughly there. How lenders determine what you can afford. I think I've been aiming at this a little bit throughout the presentation. There's two calculations that are done with every mortgage program, and that is your housing or front end ratio and your back end ratio. Your housing ratio and your back end ratio. Notice how your housing ratio has what we just covered, your complete housing payment with the different layers, your mortgage payment, property taxes, insurance, and monthly maintenance like the HOA fees if they're applicable. So that's truly the very first calculation that a lender does, and that's your housing ratio. How much of your income, how much of your gross income is tied directly to your housing payment. Once again, your housing payment, principal, interest, taxes, and insurance, right? Um, Let me give you another fictitious example. Let's just say that Juanita's monthly income, monthly gross income was $2,000 a month. If Juanita's housing payment was $1,000 a month, that would mean that our housing ratio is 50%, right? She's making $2,000 a month. Her housing payment is $1,000 a month. So that means that 50% of Juanita's monthly gross income is tied to her housing ratio. Would you say that's high? Would you say that's low? That's actually pretty high, extremely high. If 50% of your income is tied to your housing ratio. Some programs allow up to 41%, 43%, right? But just know that that's the calculation piece of affordability. The lower the housing ratio, the more affordable the payment is. The higher the housing ratio, the less affordable. So um, these calculations are really important for the lender because every program has specific requirements, such as maximum housing ratio 41%. So what that means is no matter what the payment amount is, but it cannot be more than 40% of your monthly gross income. So once again, a loan officer will walk you through this and will make the actual calculations so that your financial parameters fit the program parameters. The back end ratio takes into account not just the housing payment, but all your other monthly obligations, right? Such as your car payments, your credit cards, your student loans, child support, anything that you're obligated to pay on a monthly basis, specifically more on say your credit report, anything that's on your credit report will be tied to this back end ratio. So this is where if you have a lot of obligations, it's going to impact your affordability on your housing payment. So the more debts you have, right, the lesser your housing payment will be. Meaning, you're going to eat into this ratio. But if you're managing your debts, the less debts you have, the more of a housing ratio you can maximize. And that's once again affordability, right? Um, so just know that these two ratios are calculated so that the borrower is looked at with the ability to repay back the mortgage, including their current obligations. So um, if this was a loan officer 101 class, we probably would spend a good 2 to 3 hours making sure that the loan officer truly understands how to calculate these ratios because once again it's extremely important. And just imagine, you can actually make a mental calculation. If 50% of your income was tied to your housing payment, that's pretty steep, right? So if for some reason we lose some hours at work or we miss work and we don't make that income up, then you know that potentially can hinder our ability to pay our housing payments. Um, so just those are just some of the things that a lender looks at, because when they provide an option for a mortgage, it has to be based on the ability for that borrower to repay back that mortgage payment, right? So just you know, here we have a quick overview of the mortgage process. I know when I started the presentation, I kind of went through it rather quickly, but know that you technically don't start the mortgage process when you're buying a home. The mortgage process really starts when you found a property. So if you haven't found a property, you're still what we call pre-approved, or you're in the pre-approval stage, because although we verified your income, assets, and credit, that loan application is actually not going anywhere. It's actually sitting in a holding tank because there's no way for us to move forward, because there's nothing for us to finance. There's not a property. But once you find the property, that's when truly the complete mortgage application starts. That's when they'll do some verification. That's when they'll require you to provide additional documentation. That's when they start with the appraisal process, right? So all that starts once you found the property. So that, you know, once again, I'm just going to give you just a real quick overview of the mortgage. You know, as you can see, there's a lot more steps than just 5 steps, but this is just just kind of like a snapshot. You know, just once again, the mortgage process really starts when you've found a home. That's when things move forward. Facts about your mortgage, just you know, just in general, right? The larger the down payment, the less of a monthly mortgage payment, right? It's kind of go hand in hand, right? So the bigger your down payment, the less you're going to pay on a monthly basis. A loan with less than 20% down may require private mortgage insurance. There are some programs that do not have private mortgage insurance. Part of my role within the bank is to promote the fact that there are community lending programs out there designed for families and individuals, whether their income is considered low to moderate income, or whether their communities, based on census tract information, are considered low to moderate income communities. These programs are available where it does not have private mortgage insurance. So just know that there are some special programs out there that do not have private mortgage insurance. Your home serves as collateral for the loan until the mortgage is paid off, right? So you know that's pretty standard. Meaning, right? Yeah, my home serves as collateral until I paid off my mortgage. So what happens if I don't pay the mortgage, right? Well, that's the negative piece, that potentially it could lead to a foreclosure. Just know that your home serves as collateral. The interest rate, along with the term and the amount of the loan, determines the monthly principal and interest payment, right? So rates are at an all-time low, and I think we keep saying that every week. The rates are at an all-time low. If you take out your phone and Google 30-year fixed mortgage interest rate, rates are extremely low. When I started in the banking back in 1997, when I started my first job in the banking industry or the world, I was a bank teller, and I remember rates were at 8.5%, and people were running to the bank to refinance because it was an extremely low rate. Imagine I came to you and told you, hey, 8.5% will be your interest rate. You would laugh, right? so obviously you have a lot of information at your disposal. I'm sure that we all have smartphones or access to the internet, and there's a lot of resources that are out there. Just be mindful of where they're coming from and where you're getting them. But rates are at an all-time low. A couple of things to know. Understanding your mortgage. The APR, what's referred to the APR, is the cost to obtain your credit based on the first year of purchase, including any points that you made have paid. Now, I'll explain what points are in just a second, but the APR is not the interest rate. The APR simply calculates what the cost is to obtain that mortgage, including the interest rate. I know it's not the most easiest of definitions to understand. Um, Nowadays, when you apply for a mortgage, the loan officer provides you what's called a loan estimate, which atomizes all the costs of the mortgage. So that's a little easier to understand. Variable interest rate. A variable interest rate simply means that the rate is fluctuating along with the market flows or market movements. Um, Typically, any type of mortgage starts off as a variable interest rate. And once you lock in that loan, and I know I'm maybe throwing a wrench here, but even if you're getting a 30-year mortgage, the interest rate starts off as a variable rate until you lock the interest rate. And that's a conversation you will have once you are in the mortgage process, right? You found a home. Once the appraisal comes in, and you're really close to the finish line, that's when you have that conversation with that loan officer about locking in the rate. Speaking of rate lock, right? That's when the rate will be fluctuating, and once we lock in the rate or rate lock, that would be the rate for the life of the loan. But once again, you have this conversation when you're in the process. If you're in the pre-approval stage, we can talk rates until we're blue in the face, but your loan application is not moving anywhere. It's not until, once again, you have a property when some of these things start to kind of fall in place. Mortgage discount points. This is where once you're about to lock in the rate, you may be given the option to pay a little bit extra to have a little bit lower interest rate. Once again, right now, because of the low rate environments, buying down the rate may not be as beneficial or as attractive. But back in the 8.5 interest rate days, people would buy down points, so they would pay a little bit extra, so that the interest rate would be less, and they would be saving on a monthly basis. So their payment was a little less. So these are just some of the mortgages that are available, not just for Citi, but obviously through other banks. I'll just mention two of these programs. I mentioned quickly the FHA, the Federal Housing Administration Program. This program requires 3.5% down from the borrower, and the rest is financed with one loan. This type of program is very helpful, has helped many families achieve homeownership, but has private mortgage insurance. So just, it's a great program, but just know that it has private mortgage insurance. The Department of Veterans Affairs, the VA program, is perhaps the best program. If you're a veteran of our U.S. Armed Forces, you may be eligible for the VA program. This is truly a program that finances 100% of the purchase. This is one of the few programs that really allows for the borrower not to have to bring in money to the table. This is perhaps one of the very few exceptions, and it does not have private mortgage insurance. So very phenomenal program. I think our veterans deserve this and more. But if you are a veteran of the U.S. Armed Forces and eligible for the VA program, it's a phenomenal program. So I'll quickly mention just I don't want to spend too much time on our programs, but we do have a program. I mentioned the community lending piece. Know that Citi does have a program, as well as other banks. I will definitely be upfront, where it doesn't have that private mortgage insurance, right? So it doesn't have that extra layer of payment. So know that there's programs that do exist where you're coming in with very, very minimal down payment, or in fact, you can layer in potential down payment assistance programs if the lender participates in those programs, and know that you wouldn't have private mortgage insurance. So with that, I think I'll end here, and I'll leave enough time for us to have a Q&A session. So Juanita, I think we can open up the chat box questions.
Yes, I had one question asked that they were on deferment with their student loans, and if that would, those student loans would be counted as part of their
Very
debt.
good question. Very good question. I'm glad that was brought up. So, if you are on deferment on your student loans, basically what that means is you're not required to make payments on your student loans for a specific period of time. Oftentimes, a deferment could be for 3, 6, 9, up to 12 months, depending on the servicer. If you are buying a home, remember front end ratio and the back end ratio. The back end ratio, the lender would have to determine how much of a monthly payment you're going to have after the deferment and plug it into the ratios. Why does the lender do that? Because student loans is one of the debts that you have to pay back. Even if you were to file for bankruptcy, which I'm not saying, not, I'm just giving you an example, right? It's not advice. But even if you were to file for bankruptcy, you cannot wash away student loan debt. So knowing that, the lender would have to calculate how much of a payment you would be making sometime in the future and plug it into that debt to income ratio. There are programs that could consider the um, income-based repayment plan. So that's a little different than a deferment. An income-based repayment plan means that you're making a payment based on your income. So essentially, if your student loan payment would be $300 a month, but based on your income, you're only required to make a $50 student loan payment, then if if the mortgage program allows for an income-based repayment plan, they will take the payment of the IBR at face value. So instead of plugging into your debt to income ratio the $300 student loan payment, they will plug in that $50 student loan payment. Um, that's by exception, and the program would have to allow for that. But yeah, good question.
Perfect. Then one is asking, how do you find out about the loans that do not require PMI?
Very good question. You simply ask the loan officer, hey, um, does this program have private mortgage insurance? You see, now you're a little exposed to some of the differences
Terminology.
between programs, right? So you simply would ask, does this program have private mortgage insurance? Um, if they say no, good. Most likely they will give you a comparison between programs. They'll like provide you 2 or 3 programs. They would say things like, this one doesn't have private mortgage insurance, this one does. And depending on the situation, you can choose either or. Sometimes some programs may bump up the rate a little bit higher to compensate for the private mortgage insurance. So they'll say, like, well, if you get the FHA has a lower interest rate, but it has private mortgage insurance. If you get this option doesn't have private mortgage insurance, but the rate's a little bit higher. So once again, as long as they explain you the differences, then you can decide. Um, Once again, community lending programs, and I can say specifically for city, our community lending program does not have private mortgage insurance, and we do not bump up the rate. So now you have that in the back pocket, right? You can say things like, well, can you provide an option that doesn't have private mortgage insurance and that doesn't bump up the interest rate? So good question, good question.
Does that charge the down payment requirement? Does that change the down payment requirement?
Um, does that change the down payment requirement?
In your
So
case, it's
oftentimes,
1%, right?
I'm sorry.
In your case at the Citibank, it's a 1% down, right?
So our program is 3% down, of
Okay.
which 1% has to come from your own pocket. 2% can be gifted. So if you have a like a relative that can provide gift funds, that's great. Um, Other programs that are similar to community lending or community lending programs, for the most part, do allow for gift funds, but you just make sure that you know you check first. But for the most part, you will. be required to have, like I said earlier, a little bit of down payment from your own pocket.
So this one is saying that they have, what do you call it? They signed for somebody, co-signed for somebody, but that person is making monthly payments on time. Is that still going to affect their approval rate?
Very good question. The co-signing piece. So if they're making on-time payments, that's a good thing. That definitely is a good thing. What a lender would ask is who's making the payments, right? So if it's the other party, and the other party has proof that they've been making the payments from their account, then yes, the lender can remove that payment from the debt to income ratios, because they can confirm that although your name's on that account, another person is making payments. Sometimes what has happened is, well, they're making payments, but they're giving you the money. And then you deposit the money, and then you make the payment of the car loan, right? Although, yes, the other person is making the payment, but if that payment is coming out of your own bank account, the bank is not going to say, hey, yeah, no. They need to verify that the other party is making the payments from their own direct account. So if that's the case, then you're good.
Perfect. So somebody asked if they could ask a question, and I do welcome anyone to unmute themselves and go ahead and make a question. But they're saying, if I have a gift down payment, can that change my approval?
If you have a gift down payment?
A gifted down payment.
Okay, so a lot of programs do, a lot of programs allow for gift funds. So as long as, once again, verification, right? As long as the bank can verify the source of where it's coming, they're going to be okay with it. If they can't verify it, or if it's cash money, that's the piece where banks have to follow regulations, so they wouldn't be able to accept it. So if say mom or dad are giving you the money, typically mom or dad would send the money to escrow. Escrow is the process when you buy the house, and it's like the third neutral company, or third neutral party, I should say, between you as the buyer and then the seller. You have someone in the middle. That's typically the escrow company. So gift funds would be sent directly to the escrow company. And as long as mom or dad can verify, like the bank statement, say, yeah, I have the money, it's here's verification of it, that, for the most part, it should be fine. But if they can't verify that, that's where you start to have issues. So I guess, going back to the question, gift funds are okay as long as the lender or the program allows it, and they can verify. They can have a paper trail to verify it. You should be fine.
I have a question. I was just wondering, what is the lowest credit score that you've that is allowed for an approval?
So there are programs out there, like for instance FHA, where depending on the lender, they would allow for a score less than 620. Other, it would depend on the lender. Just want to be upfront. It would depend on the lender. Now, what's important to understand, if typically when the score is like, say, below 600, there are lenders out there that say yes, they can finance it, but it's going to require more down payment from the borrower, right? And two, the content. What's in the content that's pulling down the score? Because there may be things in there that are red flags for the lender. So even though they can lend, the score may not be the issue, but the content may be the issue.
I see. Do you help with that? Can you help?
That would be more of a credit type of counseling, either through a nonprofit, HUD organization or through the San Diego Housing Commission,
Mhm.
where they can provide you with guidance, right, on how to best proceed, or whether or not you should pay back certain debts, or um, those types of like either credit counseling or housing counseling can walk you through that process.
Okay. Thank you.
Absolutely.
So would collections to like debit credit card accounts and stuff, would that affect it? The loan?
Right. So let's just say that you have a collection, right?
Mm-hmm.
If it's from a credit card, and if it's still like an open collection where it's valid,
Mm-hmm.
yeah, most lenders would want you to, hey, we want you to make sure you pay this off before we close the mortgage. And the reason for that is, let's just say that the lender ignores that collection.
Mm-hmm.
They ignore it. You buy your house. Now you have an asset. Now you have a
Yeah.
big asset. Guess what that collection company is going to do? Oh, Juanita has a house now. I can go after the house. I can put a lien on the house because Juanita owes me money. So that's the eye opening, right? So
Mm.
because a house is a big asset, lenders are not going to put you in a position to not be successful, right? So any type of red flag that is on that credit report, they'll want to make sure that's taken care of before we finalize on that mortgage. But once again, once you're a homeowner, you have a property, and if that collection is still outstanding, they can go and put a lien on the house.
And what if the doesn't matter of the how much it is? Like say it's
So-
$1,200 collection credit card, or like a lot more. Like, would it matter?
So where it matters is whether or not, so the timing of it kind of matters as well, right? So the statute of limitation, once again, I have to say I'm not giving advice, but or
Yeah.
legal or credit advice, but after a certain period of time, you have a statute of limitation whether or not that collection company can decide to sue you. But let's just kind of play the example. Let's just say that it's a recent collection, and if that collection company decides to sue you, and let's just say they get a default judgment, that is their ticket to put a lien on the house. So the collection directly is not going to put the lien on the house. It's going through the process of getting a judgment to collect on that outstanding debt. So I hope that kind of explains it better. So technically, it's not so
Yeah.
much the amount, is whether or not they can get that judgment.
Okay. Thank you.
And just so that everyone knows, Sergio is a lender. So he's giving you the perspective of a person or the entity that would approve a loan. So if you were to go out and try to find a lender to lend you money for a home, this is where Sergio would come in. So it's one of the most important components of home purchase, because without the loan, you can't buy the home. So I don't see any more questions, Sergio, and we just ran over just a few minutes.
I have a question, Juanita. Sergio.
Ujú.
Yo soy nuevo y hoy, pues disculpen, llegué tarde, pero en 2004-2005 estaba en un edificio buscando un lugar, iba a ser un art show. Me entré a una puerta abierta en una oficina y estaban dos conversando. Uno le insistía muy así enérgicamente que si es posible comprar casa. Era un handicap y pues que tenía nomás SSI como income, pero pues ya hace mucho, yo no sé si ahora todavía es posible. Yo estoy en esa situación que soy handicap, estoy bajo SSI y pues no me ha llegado todavía, pero ya solicité hace 3 semanas mi crédito. creo que no tengo crédito, pero no tengo deudas, pues ese es en resumen, mi situación.
A ver, voy a traducirlo en inglés. Doy la respuesta en inglés y luego te doy la respuesta en español. So Abel is saying income sources, specifically from like Social Security or disability, and whether or not they can be considered as qualifying income. And the answer is yes, they can. Under fair housing, income sources are income sources if they're verifiable. So yes, you can use SSI, disability, as qualifying income for a mortgage, and whether or not I think I also mentioned about handicap, that is not in those pillars. Remember, and I'm just going to add race, ethnicity, gender, sexual orientation. None of that is part of the pillars to qualify for a mortgage. So essentially, um, it doesn't matter. What matters are, once again, the financial ability to repay back the debt. A ver, los ingresos del Seguro Social son ingresos verificables, los cuales se pueden utilizar para la compra de una casa por medio de un préstamo hipotecario. Entonces, lo que le comenté al grupo es que parte de las leyes de Fair Housing no discrimina para nada cualquier tipo de ingreso que se pueda verificar. Y le agregué también que nuestra descendencia, orientación sexual, si estamos con incapacidades, eso no tiene nada que ver con la decisión del banco o del prestamista para otorgarle un préstamo o un crédito hipotecario. Entonces, la habilidad financiera de la persona para poder pagar la deuda es lo que se toma en cuenta. Entonces, espero que le contesté la pregunta.
Sí, el income es pues como fijo y pues eso, y dónde comenzaría ahí tendría que usted tiene un website para extender
Yo no,
más.
no directamente and you know,
Es conmigo.
this setting is really educational, guys. So don't feel please obligated that you have to reach out to city. This is part of our commitment to provide information and obviously opportunities. You would reach out if anyone that wants to move the needle forward. You can definitely reach out to Juanita for guidance. But a ver si pudiera contactarse con Juanita o con el equipo de San Diego Housing Commission. No es requisito ninguno que, o sea, obviamente, o sea, claro, soy trabajo, represento un banco, pero la posición mía es de educación y de dar la información. Pero si usted quiere seguir el proceso, mi recomendación sería comunicarse con Juanita o con el equipo de San Diego Housing Commission.
Correct. So for any kind of credit counseling and getting you prepared to be able to visit Sergio or a lender, we would want to first see where you are with your credit, where your debt to income ratios, with your savings. All of that stuff would be the things that we would need to see first in order to be able to say, okay, now you're ready to go to a lender. What Sergio is doing is providing you with the educational information that you need to know to be prepared to go see him or see somebody like him in any of the banking options that you look for. Someone is asking Sergio, and this is going to be our last question because we're almost we're over the time frame, but they're saying that they have VA as their stable income, but every once in a while they are working until they start, they're not able to. So with that variance in income, what would that look like in terms of income verifications for them?
What was the first part? You said they have.
Yes, I receive most of my income is from VA.
Okay.
Sometimes
so-
it can work, and sometimes because of health issues, it stopped working. How does that work with trying to buy a house if income keeps changing?
So the VA is verifiable. So that income source can be utilized. Any other type of income, it would, I hate to use the word depend, but at times if it's a history where, say, we work 6 months and then we're off for 6 months, we work for 6 months and then we're off for 6 months, if that's a pattern, then potentially the lender could average out the income, right, and use a portion of it. But that would be more like on a case by case basis, because the employment piece, if we're going to use income from employment, employment has to be verified for the past 2 years. So there's a few exceptions. Once again, like I mentioned, if there's a history of the pattern, right, like we work seasonal or we work during the summer months, but if that's a pattern, then that can move forward. But if it's not a pattern, then if the employment income isn't stable, then potentially they wouldn't consider the employment income, but they would consider obviously the VA income portion.
Perfect, Sergio. Thank you so much for taking the time out to come and talk to all of us and give us information from a lender's perspective. Next time that we have another workshop, I'm hoping we'll have somebody else. Not that we don't love you, Sergio, but maybe an appraiser or an inspector.
Absolutely.
Or
No, absolutely.
okay,
Absolutely.
and so
thank
that
you,
we can
Juanita,
have
and
another.
thank you everyone for participating, and please send my regards to the rest of the team at San Diego Housing Commission.
We will. We have two online now. So Sylvia's on, and so is Monica. You probably haven't met Monica yet, but I would want you to meet her. She's one of our she's new to us.
Oh, cool. Well, welcome. Thank you, Juanita.
Okay, Sergio. Thank you. Everyone, thank you and have a great one. Bye.
Bye.